Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. My favorite chess quote is by the ex-world champion Robert James Fischer, which is, to get squares, you have to give squares. It means in order to achieve gains, you have to pay a price. Now, no doubt, the macro move that caught investors' attention over the last few sessions was the sharp drop in the pound sterling. The UK is facing near double-digit headline inflation and 6% core inflation. The key reason is the rising electricity bills in the face of gas shortages as Russia curtails exports in response to increased sanctions. Now, in response to this, the UK government unveiled a fiscal stimulus which includes tax cuts worth £45 billion and support for covering energy costs worth £60 billion over the next 6 months. Now, the government must have known that in order to boost growth and ease the burden on consumers, they risk facing a twin deficit. But they must have assessed this as a risk that they are willing to take. This fiscal stimulus will add to the government's funding requirements at a time when the Bank of England was already intending to reduce the size of its balance sheet. Also, this move could be putting additional upward pressure on inflation, requiring the BOE to tighten monetary policy even more aggressively than it was intending to. And now, of course, there could be looping effect because the weaker pound sterling will also increase inflationary pressure to some degree. So, looking at the price action, pound sterling broke below its all-time low against the dollar at 1.14 last week due to global risk-off. And the drop nearly reached parity to the dollar on the back of this fiscal stimulus news. Now, it is doing a 62% Fibonacci retracement of the move yesterday, but we do not rule out the pair retesting its intraday low at 1.0380 in the near future. But it is not all doom and gloom here. While the sterling may continue to be under some pressure, there could be positive for the large-cap UK equities. For example, companies in FTSE 100 derives more than 70% of their earnings from overseas. The weakness in the pound could bode well for the earnings in terms of currency translation. UK equities are yielding 2% higher than global equities and valuation at nearly 40% discount to the global counterparts. That's all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.